Folks, you are not going to believe how cleanly the tape has set the board for the week ahead. Last week, the market pushed into fresh record territory on the back of artificial intelligence momentum, while crypto refused to roll over and gold marched steadily higher. Yet beneath that surface calm, the geopolitical currents kept swirling. U.S. naval movements in the Gulf raised eyebrows in Tehran, just as diplomats hinted at possible talks in Islamabad. China delivered an export surprise that the mainstream headlines called a trade war rebuttal, but the tape simply treated as confirmation that capital still finds a way. And through it all, the VIX stayed remarkably disciplined, refusing to spike, even as headlines tried to manufacture fear. That combination, my friends, tells me the week ahead is going to test exactly what kind of trader you really are. Because when everything looks this orderly, smart money starts positioning for the moment the order breaks. And that is precisely where VixShield shines. This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. Now listen. Saturday, I walked you through how the market had priced in diplomatic progress faster than the pundits could type their alarmist headlines. I told you the tape had already digested the latest round of sanctions threats and the China export beat, and that the real story was the quiet resilience in risk assets. Well, here we are on Sunday, and that same resilience is still intact. Bitcoin closed the week firmly above $80,000. Gold climbed steadily to fresh highs. The dollar eased just enough to keep the carry trade breathing. And the S&P 500 sits near those record levels, with artificial intelligence names still leading the charge. You and I both know what really happened here. The mainstream told you to fear escalation in the Strait of Hormuz. The tape looked at fresh naval posturing, said that is already in the price, and kept grinding higher. That is the setup smart money noticed last week. And that is the exact setup we are carrying into Monday morning. Here is the thing. When you combine record equity highs with contained volatility and rising commodity prices, you get a market that is simultaneously optimistic and guarded. Optimistic because artificial intelligence demand keeps lifting the major averages. Guarded because any genuine flare-up in the Middle East would send crude oil ripping higher, and that would change the entire risk equation overnight. Crude oil did pull back from its highs during the week, yet it still finished firm. That tells me energy markets are watching the diplomacy closely, but not panicking. Gold, on the other hand, ignored every dip in the dollar and kept climbing. Gold climbed steadily. Gold looked at the strongest parts of the dollar and said, "That is cute." Gold simply does not care when real geopolitical tension simmers beneath the surface. That is the first major thread we must watch this week. The second thread is China. Beijing posted stronger than expected export numbers right before the Trump-Xi summit. The headlines called it defiance. The tape called it resilience. Asian markets took the baton and ran with it, providing a positive lead for U.S. futures. That spillover effect often sets the tone for the first 2 hours of trade on Monday. If we open firm on that Asian strength, then the question becomes whether the momentum can survive the light economic calendar early in the week. Because let us be honest, the real fireworks are scheduled for the back half. And then there is the Iran situation. U.S. officials floated the possibility of resuming nuclear talks on a 14-point framework that includes sanctions relief. Tehran immediately pointed to recent American naval movements in the Gulf as undermining any goodwill. Now ask yourself, when was the last time you saw diplomacy and military posturing happening at the exact same time, with markets barely flinching? That is what disciplined capital does. It prices the risk premium in advance, then waits for actual delivery. The VIX stayed in the high teens all week. That is not the behavior of a market expecting sudden chaos. That is the behavior of a market that believes the diplomatic track still has runway, but runway can end quickly, and that is why we stay prepared. Let me pull back for a moment and connect this to your iron condor positioning. Every single day we place a fresh, defined risk structure between 3:05 and 3:14 Central Time. That trade expires the next market day. No carryover, no rolling, no hoping the position survives until Wednesday. Monday is its own battle. Tuesday is its own battle. This independence is what protects us from the kind of overnight gaps that destroy directional traders. Last week we placed 4 trades. 3 expired worthless for full credit. 1 touched the short put for a defined loss. That is the math. That is the discipline. And that is exactly how we approach the 5 fresh opportunities waiting for us this week. This is where it gets interesting. The economic calendar looks deceptively light at first glance, but the events that are scheduled carry extra weight because of the geopolitical backdrop. Monday and Tuesday give us breathing room. We will see some housing data and perhaps a few Fed speakers, but nothing that typically moves the needle hard. That calm period is perfect for watching how the market digests last week's gains. If we hold these record levels through Tuesday, then the real test arrives midweek. Wednesday brings the next inflation snapshot. Traders will be watching whether price pressures remain anchored or whether the latest round of tariffs and supply chain noise is finally showing up in the numbers. You and I know the mainstream will spin any surprise as proof that the Federal Reserve is behind the curve. The tape will do what it always does. It will look at the actual data and decide whether volatility deserves to expand. If the print comes in line with expectations, the VIX term structure should stay in its current orderly state. If we get an upside surprise, then we may see a quick bid in near-term volatility. Either way, that data point will set the tone for the rest of the week. Thursday is Federal Reserve Day. Not a formal meeting, but several high-profile speeches are on deck. The market has grown accustomed to parsing every word for hints about the next policy move. Last week, the bond market barely budged. The 10-year yield drifted modestly lower. That tells me investors are not yet convinced that inflation is reaccelerating. But if the inflation data on Wednesday comes in hot, then Thursday's speeches will be watched like a hawk. One hawkish comment, and we could see the dollar firm, while equities take a modest breather. One dovish comment, and the risk on tone could accelerate. This is precisely why we never make directional bets. We simply structure our iron condors to handle either outcome with defined risk. Friday brings the weekly jobs picture and more housing metrics. By then, the market will have had time to digest the inflation and Fed signals. If the employment data shows continued strength, it could reinforce the idea that the economy does not need immediate help from the central bank. That would be supportive for the dollar and slightly negative for gold. But remember, gold has ignored plenty of strong data lately. It is trading on geopolitical tension more than economic strength right now. That divergence is one of the cleaner tells we have seen in months. And let us not forget the ongoing trade negotiations. The Trump-Xi summit is approaching. Any leaks or progress reports could swing sentiment in either direction. China is clearly signaling it can withstand elevated tariffs. The question is whether Washington reads that signal as an invitation to push harder or as a reason to de-escalate. Markets hate uncertainty, yet our defined risk structures do not care about the headline. They only care about where the S&P 500 finishes at the close. That is the beauty of what we do. Now I want to spend a moment on the VIX term structure because it is sending a very clear message heading into this week. The curve remains in contango. That simply means longer dated volatility is priced higher than near-term volatility, the calm, normal state of markets. When the term structure sits in this shape, it tells us that big money is not rushing to buy crash protection. They are happy to sell it instead. That environment has historically favored the kind of short premium strategies we run. But we never get complacent. If the curve starts to flatten or invert, that is the market telling us the risk premium is changing. We watch that every single day. Because the term structure does not lie. The headlines lie. The term structure simply reflects where capital is actually flowing. Let us talk about the Friday RSI strikes we placed, because this is where the rubber meets the road for your portfolio this week. We entered the conservative iron condor with strikes that give us a comfortable range on both sides. The balanced version is a bit tighter as usual, and the aggressive one carries the narrowest wings for those who want maximum premium. For all three to win, we need the S&P 500 to close this week between the short put and short call on each respective structure. That is it. No guessing the direction. No hoping for a breakout. Just stay inside the range and we keep the full credit. Now think about what that means in the current environment. If the market continues its grind higher on artificial intelligence strength, we are perfectly positioned to benefit. If geopolitical nerves cause a modest pullback, we are also fine. The only scenario that causes a defined loss is a violent move through either wing. And those violent moves almost always come from unexpected shocks. That is why we keep the adaptive layered VIX hedge on standby. ALVH is not some complicated overlay that requires constant adjustment. It is our second engine. When the primary iron condor faces pressure, we layer in targeted VIX exposure that offsets the loss. The beauty is that each day is independent. We do not drag Monday is problem into Tuesday. That discipline alone has saved countless accounts during turbulent periods. I have said it before, and I will say it again. The mainstream wants you to believe that successful trading requires predicting the next headline. You and I know the truth. Successful trading requires preparing for a range of outcomes and managing risk so that no single outcome can hurt you permanently. That is what these iron condors deliver. Defined risk, defined reward, daily resets. It is almost mechanical once you internalize the process. Pulling back to the bigger picture, we can see 5 distinct geopolitical and policy threads that will influence capital flows this week. First, the Middle East tension. Any progress or breakdown in the US-Iran talks will move crude oil and by extension, the broader risk appetite. Second, the China trade dynamic. The upcoming summit could produce headlines that swing sentiment hard. Third, the inflation data. Whether it confirms or denies the tariff impact will set the tone for Federal Reserve expectations. Fourth, the dollar path. The DXY eased during the week, but remains in a firm, longer-term trend. That strength supports American assets, but pressures emerging markets. Fifth, the artificial intelligence momentum. As long as the big tech names keep delivering earnings beats, the market has a built-in bid. These 5 forces are constantly interacting. Our job is not to pick the winner. Our job is to structure positions that profit from the math, regardless of which narrative prevails. This is the conservative truth-seeking lens we apply every single day. We do not trust the headlines. We trust the tape. The tape showed us last week that risk assets can absorb geopolitical noise when artificial intelligence demand remains strong. The tape showed us that gold can climb even as the dollar holds firm. The tape showed us that Bitcoin can push above $80,000 without dragging volatility higher. Those are facts, not opinions, and those facts inform how we set up for the week ahead. The Federal Reserve continues to walk a tightrope. Policymakers want to see inflation sustainably at target before cutting rates. Yet the longer they wait, the more pressure builds on rate-sensitive sectors. We saw that tension play out in the bond market last week. Yields drifted lower, but not dramatically. That modest easing tells me investors are still comfortable with the current path. But comfort can evaporate quickly if the inflation numbers surprise to the upside. That is why we watch the term structure so closely. It is the market's early warning system. So let us review the scorecard from last week and how it shapes our approach now. We placed 4 trades, 3 delivered full credit, 1 triggered the defined loss on the short put side. That 80% win rate is exactly what we target over time. It is not about winning every day. It is about winning consistently enough that the math works in our favor. The losing trade reminded us that even in calm markets, a single headline can breach a wing. That is why we never risk more than a small percentage of capital on any one day. That is why the adaptive layered VIX hedge exists. That is why we review every outcome with ruthless honesty. Looking at the cross-asset behavior, we see confirmation of the risk on tone. Bitcoin surged early in the week and held most of those gains. Gold climbed steadily throughout the 5 days, refusing to give back ground. Crude oil pulled back from triple-digit levels, but found support and stabilized. The dollar eased modestly, which helped foreign assets breathe. These movements are not random. They reflect capital rotating toward real assets while still participating in the equity rally. That rotation is healthy. It prevents the kind of concentrated bubbles that eventually pop violently, and it gives us a diversified set of signals to monitor each morning. The VIX trend rules remain in neutral territory. We are not in an elevated volatility regime that would force us to tighten strikes dramatically, nor are we in such a complacent regime that we can widen them excessively. The current setup calls for balanced positioning with the flexibility to adjust if the term structure shifts. If the VIX stays in the high teens, our entry conditions remain favorable. If it suddenly drops toward the low teens, we may see premium compression that requires more patience. Either way, the process stays the same. We follow the signals. We do not chase. Tomorrow, in our Monday morning update, I will walk you through the exact RSA signals for the day. I will show you how the Asian lead combines with the light calendar to create our opening range. I will review the overnight moves in Bitcoin, gold, and crude, and explain what they mean for your iron Condor placement between 3:05 and 3:14 Central. If you are new to VixShield, this is the perfect time to observe the process before committing capital. We make every decision transparent. We explain the why behind every strike, and we never pretend the market is simpler than it actually is. And be sure to listen for any breaking news from Miss Vicky. She will flash the critical updates the moment they matter. If you found this summary valuable, consider upgrading to Pro or higher for the full twice-daily VixShield market summaries, proprietary signals, and private RSS feed. Visit VixShield.com to learn more. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. This is VixShield, your protection against market uncertainty.